And they're all focused on one company, DVN Energy. Ticker is DVN.
That's right. And a consensus, I mean, it's really striking. It's a strong buy across the board.
It really is. Our mission today is to cut through all that and figure out why. What are the numbers behind this really bullish feeling?
Well, the core finding is pretty bold. It's not a small call they're making.
It's compelling, for sure. Analysts are projecting an average price target that implies, what, nearly 24% upside from where the stock is now?
And for a major U.S. oil producer, a large cap company like Devon, that's a huge potential move.
Yeah, we're not talking about some speculative small cap stock here.
No, not at all. We're talking about a significant potential gap in valuation for a company with very proven operations.
So here's the hook for this deep dive. The stock closed Friday. That was January 9th, 2026, and it was down just a little bit at $35.76.
Right. And when you pull all these reports together, that average price target is sitting way up there, over $44.
$44.62 to be exact. So the big question we're asking is this small dip the ultimate buy moment that these reports are basically screaming about?
And the analysts seem to think the answer is a clear yes.
Yeah.
Because it looks like the market is just fundamentally mispricing the stock right now.
Okay, so let's start right there. Let's get into that value disconnect.
Perfect.
We know the price, $35.76. So if you're buying today, you're getting a discount. But what is the one metric, the one number that makes this so compelling?
It all really boils down to the price-to-earnings ratio, the PE.
Okay.
And for Devon Energy, that number is sitting at a staggeringly low 8.41.
8.41. Wow. Okay, for anyone listening right now, let's put that number in context. Why is 8.41 considered, rock bottom, especially for a company of DVN's size?
Well, think about what a PE ratio tells you. It's how much you're paying for every dollar the company earns in a year.
Right.
Now, if you look across the market, especially over in the tech sector, you'll see PE ratios of 30, 40, maybe even 50. Investors are paying a huge premium for future growth that they hope will come.
So you're basically buying potential.
Exactly. You're buying the story. Now, in energy, the multiples are always lower, but even next to its direct competitors, its peers in U.S. oil and gas, 8.41 is extremely conservative.
So the market is pricing it like its best days are behind it.
That's a perfect way to put it. It's like the market is applying this deeply pessimistic multiple to DVN's current, very real, proven earnings. It's acting as if profits are about to fall off a cliff, even though there's no sign of that.
So the argument is the market is just betting against Devon, even though the company is actually performing, exceptionally well right now. It's valuing it based on old fears, not the current balance sheet.
That's the textbook definition of a classic value disconnect. You're buying $1 of their earnings for just $8.41. And that provides a kind of a structural safety net for an investor.
A safety net? How so?
Well, the low PE means the risk of a huge stock price drop because of overvaluation is much, much lower. If the company just keeps doing what it's doing, there's a strong floor into the price.
Okay, so the low PE is the safety net. That makes sense. But we need to know what's the engine that could drive that 24% growth.
Right. And that brings us to the bull case, the three big internal reasons the analysts are so excited.
And it all starts with their cash flow, right? They're calling it a cash flow machine.
This is where we shift from, just avoiding risk to actually chasing that upside. And it's all built on free cash flow, FCF.
Which for an oil and gas company is probably the most important number to watch.
It's everything. It's the cash that's left over after they pay for all their operations and all their big capital spending, the drilling, the equipment, all of it.
So it's the money they can really do whatever they want with, the money they can use to pay investors.
Precisely. And in the last quarter, Q3, Devon generated an incredible $820 million in free cash flow.
$820 million in one quarter.
Yeah. To put that in perspective, it's like having almost $1 billion just sitting in your checking account after every single bill is paid.
That is a massive war chest. So how are they using it? I mean, generating cash is one thing, but management has to deploy it wisely, right?
They do, and they're doing it in the two ways shareholders love most, paying out solid dividends and buying back their own stock.
And the report mentioned the dividend yield.
A strong 2.68% dividend yield. So you get paid that income just for holding the stock while you wait for that valuation gap to close. And that dividend is very safe because it's backed up by that huge FCF machine.
That's a great combination. You get the value investor's potential for growth, but also the income investor's stability.
Exactly.
So, okay, cash flow is driving stability. What's driving the confidence in their future performance?
And that leads us to the second pillar, their operational excellence. Specifically, what analysts are calling a beat and raise quarter.
Beat and raise. That's kind of the gold standard for an earnings report, isn't it?
It absolutely is, because it shows two things at once. Fantastic immediate performance and real confidence about the future.
So walk us through it. What does beat and raise actually mean here?
So the beat part means they exceeded Wall Street's expectations for the quarter. Pretty simple. But the raise part, that means management felt so good about how things are going, they actually increased their financial guidance for the next few quarters.
It's like hitting a home run and then pointing to the stands and saying you're going to hit another one.
That's a great analogy. It speaks directly to their discipline and their execution.
So let's look at the numbers. What was the beat?
Wall Street was expecting earnings of about 95 cents per share. DVN came in and delivered 1.04 cents.
$1.04. That's a pretty big beat on the bottom line.
It is. It shows they're controlling costs better than anyone expected and getting strong prices for their product.
And it wasn't just on the money side. They were pulling more out of the ground, too.
Correct. They also delivered higher than expected production. They hit 853,000 barrels of oil equivalent per day.
So when you can pump more product and keep more profit per share,
that's when you know the operation is just firing on all cylinders. And it really validates the idea that an 8.4 PE is just, well, it seems irrational.
Okay, so we have massive cash flow, we have stellar operational results, but the third reason for all this bullishness is more forward-looking. One report called it their secret weapon, the business optimization plan.
Yes, and this is what really connects the great performance they're having now to that future $44 price target. The plan is a strategy to improve their annual cash flow by a total of $1 billion.
$1 billion on top of the $820 million they're already generating per quarter.
$1 billion annually, yes. It's a huge number.
How are they even going to do that? Where does $1 billion in new cash flow come from?
Well, what the analysis really stresses is that this isn't about, reckless cost cutting that could hurt the business long term.
Right.
They're focusing on structural efficiencies. Things like optimizing their drilling techniques in key areas like the Permian Basin, streamlining their administrative costs, stuff like that.
So it's not about cutting muscle, it's about making the muscle work more efficiently, smarter.
Exactly. And the real power of this, in the analyst's view, is that they're driving these efficiencies while still maintaining or even slightly raising their production guidance.
So costs go down, revenue stays strong or goes up.
And every single dollar from that improvement flows straight to the bottom line. It reinforces their earnings growth and provides this powerful structural reason for that PE gap to finally close and for the stock price to rise.
This all sounds incredibly compelling. I mean, the logic is all there, but I have to ask, why is the market still waiting? If all of this is true, why is the stock still at $35?
That is the multi-billion-dollar question, isn't it? And there are likely some external factors at play. Broader fears about the economy, maybe some uncertainty about oil prices long term, or just, a general lack of excitement for traditional energy stocks right now.
So DVN is being punished for things outside of its control.
That seems to be the case. And the beauty of that, the actionable part for you, is that the analysts see this price as an opportunity because the market is focused on those external fears and not DVN's internal reality.
Okay, let's bring it all home. Let's connect these fundamentals, the 8.4 PE, the cash flow, the beat and raise, that billion-dollar plan, to the final forecast. Let's do the final math.
The strength of all these internal factors has created a very clear consensus on Wall Street. The overall view is a moderate to strong buy.
They just believe the current price can't hold, given the profitability.
Exactly. It's seen as unsustainable.
And that target number we keep coming back to is $44.62. So if you're buying today at around $35.76, let's walk through the gain if it hits that target.
That move from $35.76 up to $44.62, that equals a gain of just about 24%.
24% on the share price alone.
On the share price alone. And like we said, that's before you even count the nice quarterly dividend you're collecting while you hold it.
A 24% potential gain, plus a stable dividend, all sitting on top of that safety net of a low PE. When you look at the risk to reward on that, it looks fantastic.
It does. You seem to have limited downside because of that deep undervaluation, and you have these very clear internal catalysts that could drive the stock higher.
So the analysis really suggests that the robust performance and low valuation give you a safety net, while management's execution provides the spring for that potential growth.
That's the reason the risk to reward is seen as so favorable right now.
Okay, so to summarize our deep dive on DVN, the case for that 24% upside really rests on three strong pillars. First, the valuation. That rock bottom PE of 8.4 suggests it's just massively undervalued compared to its actual profits.
Second is that cash flow machine. The $820 million free cash flow last quarter, which is funding, returns to you as a shareholder, plus that internal plan to find another $1 billion in cash flow through optimization.
And third, it all points to a clear line of sight to that 24% potential upside to get the stock to that $44.62 average target. It's a really powerful argument for a stock that seems to be overlooked.
It is. The whole analysis provides this compelling picture of internal health, of operational discipline. The entire forecast is built on things the company itself is controlling: its earnings, its cash flow, its dividends, its efficiency plans.
This is where we want to leave you with a final provocative thought, something to take with you for your own research.
Right. The analysis we've just gone through focuses almost entirely on what DVN is doing right, the things that its management team can actually control.
And that raises a really important question for you, the listener. If this price target is driven by all these internal metrics, what are the external factors you should research next to really pressure test that $44.62 target?
The things outside of management's control.
Exactly. Think about the bigger picture. What happens if there's a big, sustained drop in global oil prices? Or what if the entire energy sector just falls out of favor because of some political shift? How much protection does that 8.4 PE really give you then?
Understanding that dynamic, that interplay between DVN's strong internal execution and those unpredictable external forces, that's how you go from just being informed about a stock to making a truly critical investment decision.